Hello and welcome to this video on Introduction to Accounting by White Knight Ventures. In this video, we will be giving you a brief about what is accounting, why is accounting needed, what kind of financial statements are prepared by firms to depict their financial accounts, and what are accounting concepts and what kind of concepts are used in day-to-day lives while preparing the accounts or financial statements for a company. First question that we address is, what is accounting? Accounting is a process of recording, summarizing, analyzing, and reporting financial transactions for a business. The key financial statements that are prepared by business entities are Statement of Profit or Loss, also known as Statement of Comprehensive Income, Statement of Financial Position, also called Balance Sheet, Cash Flow Statement, and Statement of Changes in Equity. We will be looking at these four statements in depth in our subsequent video, where we will be telling you that why all these statements are prepared, that is, what is the purpose of each statement being prepared, and how they are prepared. Now, these statements of financial accounts that we publish or that we produce are of interest to various stakeholders that have some sort of interest in the company in one way or the other. For example, shareholders, creditors, employees, customers, government agencies, competitors, foreign agencies, etc. All of them will have some sort of interest or stake in the company's well-being or company's functioning. All these people will definitely be looking at the financial statements for their own purpose. Let us look at some of their key interest areas as to why they would require accounting to be of a certain kind. Shareholders. Shareholders are the people who own the company. That is, these are the people who have invested their own money in the functioning of the firm. They would be looking at the financial statements very, very closely on a regular basis because they would want to judge the profitability and performance of the company on a regular basis, look at how the management is performing and dealing with their money and whether as investors, they're generating enough returns from the same place or not. Also, they will use these accounting statements to help forecast the future growth possibilities, future sales, future profitability of the firm, etc. Employees would be interested in the financial statements of a company to see whether the company is going to perform well in the future, will be safe from their job security perspective, will be stable enough to pay their salaries. At the same time, will the company grow so that they can have some opportunities to grow in their career. Creditors are the people who have given loan to the company for its functioning. Therefore, they would be interested in the risk of default, that is the probability that the company goes bankrupt or does not repay the loan that has been forwarded to it by the creditors of the firm. They would also be interested in looking at the adequacy of the assets, that is, whether the assets are enough in number and amount to pay off the debt that the company has from these creditors in case the company winds up or shuts down its business. Also, they would want to see whether the covenants, that are the terms and conditions laid down in the loan contract by the creditors in front of the company, are being met through the financial statements of a company. Others such as government agencies, customers, competitors, etc. would be interested in the continuity of the business. For example, if you're purchasing a car, you would want to purchase it from a company that would be in the running for a long period of time, so that if you require repair or maintenance or exchange of parts in the future for your car, you have that brand available in front of you. Similarly, both the government agencies as well as competitors would be interested in the trading and pricing policies of the firm. Government agencies to ensure that they are not entering into any malpractices, or they are not having monopolistic and restrictive trade policies, or they are not having pricing policies which are exploiting the customers in an illegal or an unethical way. On the other hand, competitors would be very, very interested in looking at what kind of strategy the company is taking up, whether they want to price their product at a low level so that they can have a larger market share and a larger sales volume, or they are trying to keep it at a high level and go for the niche markets in the industry. So these kind of things can be inferred from the financial statements that are presented by the management of the firm to various stakeholders in the being. The main motive of preparation of financial statements should always be to give a true and fair view of the performance of the company, of the financial position of the company, of the cash flow position of the company, etc. It should the bottom line should be that it is true and fair. Whether it is depicting a picture which is rosy, whether it is depicting a picture which is dangerous, it should not be tampered with by the management to give you an untrue, over optimistic, or unfair view of the well-being of the company. There are various sources of regulations that each and every business entity, a company, or a firm have to that they have to adhere to. There are sets of regulations, rules, laws that are imposed upon these firms in order to make sure that the financial statements that are being prepared by them give a true and fair view to the different stakeholders that are there. First one being principles, concepts, and conventions. We will be looking at some of the accounting concepts towards the latter half of this class, but these are the principles, concepts, and conventions that are practiced worldwide by companies in order to maintain their standard of reporting about their financial transactions. At the same time, these conventions and concepts help create some sort of homogeneity in the financial statements that are prepared by companies, so that investors, shareholders, creditors, banks, etc. can compare between industries and between companies by looking at their different financial statements. National company laws are laws that are set up by the economy in which the company is working in. So every company will have to abide by those laws while they are producing their accounts and annual reports. Best industry practices are things that are being done by the competitors or peers in your industry. You would always want to make sure that the disclosure that is being made through your accounts and annual report is done in such a manner that it is considered as the best practice, so that people show trust and people can believe in what you're doing, and that will in itself create a goodwill or a brand image about your company. Stock exchange requirements. If the company wants to list itself on a stock exchange and become a public limited company, they will have to adhere to certain requirements on the stock exchange that they are being listed upon, because the stock exchange would want to maintain a certain level of disclosure. They would want to maintain a certain stipulated timely disclosure of things to happen, be it quarterly, be it monthly, be it biannually, be it annually, or be it semi-annually. These are the things that the company will have to meet if they want to be listed on that stock exchange. Other legislations with respect to various other bodies that you would be answerable to or be regulated by, they would want you to disclose certain things in your annual reports and company accounts accordingly. Lastly, we have the IFRS, that is the International Financial Reporting Standards. These are being implemented across the world so that there is homogeneity in reporting standards across economies. So if you want to compare a company which is working in India vis-a-vis a company with a company working with a company from South Africa, you should be able to do that provided the statements are being prepared at a homogeneous level on same standards and same grounds. That is what IFRS is trying to establish, so that there is homogeneity and comparability increases, which is obviously to the betterment of the investors. The statutory requirements that are there for financial statements of a company are statement of financial position, that is a balance sheet, statement of profit or loss, which is the statement of comprehensive income or profit and loss account, notes to accounts. Now, notes to accounts are a very, very key component because they tell you various things that might not be reflected directly by the financial statements that were stated before. So they would probably tell you that what are the different methods or assumptions that the management has taken up whilst they were preparing those statements. If there is some key fact that they want the investors or the stakeholders to take a note of whilst they're going through the financial statements, may be mentioned in the notes to accounts. If they've declared certain policy changes, or if they've changed certain methods of calculating certain aspects in the balance sheet or in the profit and loss account, that would be mentioned there as well in notes to accounts. director's report, and finally the auditor's report. These are the 5 key things that are required by each and every company to report on. What is a director's report? A director's report gives you an insight into the activities of the companies in the past 1 year, as well as some idea of what the company is planning to do in the coming year. Financial details with respect to share capital, like the retained earnings, proposed dividends, buybacks, etc., are a key element in the director's report. Remember, the directors are the people appointed by the shareholders who are responsible for running the company and taking key decisions of the company. So it is basically the director's report, that is what they feel that the company has been doing and how they have been trying to achieve the targets that's set for the whole group of stakeholders that are interested in the company's well-being. Details of shareholders, their shareholdings and interest in the company are also mentioned in the director's reports. Auditor's report. Now, who is an auditor? An auditor is a professional who gives his or her opinion on the financial statements prepared by the management or the company. Now, remember that the shareholders and the management, especially in big companies, would be different from one another. So there will be a divorce between the ownership and management of the firm. This gives rise to something called the principal agency problem, where the management might have different interests which are not aligned to the best interests of the firm. Therefore, to make sure that the report or the financial statements prepared by the management are giving a true and fair picture about the company's existence, an auditor is hired to go through the financial statements and provide his or her opinion about whether the financial statements have been prepared correctly or not, and if it is not, then what is wrong with it, right? So auditors, in their opinion, comment on whether the statements have been prepared properly and provide a true and fair view or not. This report adds credibility to the financial statements prepared by the company and when they are published in the public domain. Auditors, as I mentioned, are appointed by shareholders, and it is a mandatory thing, especially for big-sized firms, by law. Generally, the auditor's report contains the person or the people who it is addressed to, introduction to the financial statements, sections such as responsibilities of directors and auditors, basis of auditor's opinion, and finally the opinion. And lastly, it will have the signature of the auditor and date of the report. Right? Now, an auditor can give you various kinds of reports depending upon the kind of information he or she has been able to infer from the financial statements. If they feel that it is a perfect way of reporting, the financial statements prepared by the management are correct, it is giving a true and fair view, and there is no ambiguity or any problem associated with the financial statements, it gives you an unqualified opinion. That is, it's a clean sheet. The financial statements are absolutely perfect according to the auditor, given the information that he or she has at disposal. However, in certain situations, providing an unqualified report is not possible. So in that situation, he provides you a qualified report. Now, there can be various degrees of qualification that he or she can take up. First one being emphasis of matter paragraphs. Emphasis of matter paragraphs is used when they feel that all the financial statements have been prepared properly. They give a true and fair view. However, there are a particular set of issues or an issue that the auditor wants to bring to light for the stakeholders to take key note of. That's it. So he or she might want to write a paragraph or emphasize on a paragraph about that particular issue. However, the rest of the things are fine according to him or her. Second one being qualified opinion. This says that the report is fine, except either there has been limited access given by the company's management to the auditors to find out about the statements, whether they are being prepared in a true and fair view or not, or if there is a particular treatment or a few treatments that the auditor disagrees with what the management has done. In this situation, he or she will provide a qualified opinion. Third is a disclaimer of opinion. This is used very rarely, but it means that an auditor has faced an extreme situation. That is, he or she cannot form an opinion given the kind of information or situation he or she has been put to. So, in this situation, he says that there's a disclaimer of opinion where he cannot say whether the statements are being prepared in a true and fair manner or not, whether they are depicting whether they are having some issues or not, nothing. So, they do not make any opinion whatsoever. Lastly, it's an adverse opinion. This is the worst kind of opinion that that a set of financial statements can get. It says that the statements are misleading, all right, and this is obviously the worst outcome that an audit report for a management can give. So the auditor says that the report has been prepared in an untrue and an unfair manner, and the picture that is being presented through these financial statements are absolutely misleading and untrue. So if you go from point 1 to point 4, it obviously shows that the statements that are being presented to the auditor are worsening from point 1 towards point 4. One is where he had an issue with a couple of things. Rest everything was fine, so he just wanted to bring it to the notice of the stakeholder. A qualified opinion was where everything was fine, but either he had limited access to the information or there were a couple of treatments where he was not completely in agreement with the management. Third was a disclaimer of opinion where the auditor says that he or she has not been given enough scope or enough information to make sure that he or she can comment on the statements that have been prepared. And lastly, an adverse opinion is where he or she puts the foot down and says that these statements are untrue and unfair and are not reflecting the true picture of the firm. There can be two major issues with auditors. First is known as conflict of interest. Now, major audit firms generally that are doing the rounds in the world also have consultancies that help investors in choosing or picking their investments or stocks or bonds from different companies. Now, here they can have a conflict of interest. One team is auditing a particular firm, and there's another team who is consulting or who is asking investors to invest in certain sets of firms. The team which consists of auditors who are looking at the internal accounts or have insider information about the companies can actually leak information to the consultants and make sure that they have some sort of revenue that is being generated for the investors. So this kind of conflict of interest might arise, where for their better use or for their better picture in terms of in front of the investors, they can use insider information and make insider trading possible and have some sort of conflict of interest. Secondly, there is something called familiarity threats. If the same auditor has been associated with a particular company for a long period of time, the management may become familiar with the auditor, and then there can be a situation where the auditor might become friends with that person, with the management, and might not give an adverse opinion about the financial statements prepared by the management, even if the management is preparing one. Right? International Accounting Standards Board, IASB, is the body that develops the accounting standards called the International Financial Reporting Standards, IFRS. This is what we had seen a little while ago in Sources of Regulation. They try to provide you with standardized policies or standardized conventions and principles so that all the companies across the globe prepare statements in a uniform manner so that there can be comparison that is possible within economies and industries. So we have a team or we have a thought which supports standardization, but however, we also have a school of thought which goes against standardization. First, we look at the positives of standardization. It reduces variations in companies' accounts, as I've been telling you again and again, that it brings in uniformity. It helps in comparison that can happen between countries, between economies, between companies. Secondly, it focuses on particular areas of accounting. So it will focus on key areas, key aspects that the investors and stakeholders might be interested in. So that way, it will reduce the flexibility of the management to choose to report on whatever they would like to. So rather than doing that, we tell the management that these are the things that you should focus upon and elaborate upon whilst you're preparing your financial statements. More disclosure compared to national laws. Generally, IASB-led IFRS leads to more disclosure of finances or key aspects of the firm's functioning than the national laws would ask them to. More flexibility than legislation provides them to have. However, there are negatives of standardization. First one being every standard that the IFRS is building may not be appropriate for all companies. Some standards may suit some companies, some standards might not suit certain companies, depending upon the kind of industry they are in, depending upon the size of functioning they are in. In certain cases, there might be a company which is a huge conglomerate and has businesses in different industries. There, applying the same standard across industries might not be possible for that firm to take up. Standards may be implemented due to political pressures or lobbying, which will again distort the whole thing about focusing on particular areas for accounting, so that there can be so that the disclosure can be better for investors and stakeholders. As we have already mentioned, that it gives you flexibility in the positive standardization. The negative side of this is that if you allow more than one method to report upon on a certain aspect, it automatically deflates the purpose of bringing uniformity in account preparation. And lastly, some standards are too general and meaningless. Thus, it does not give any truth to the IFRS objective of bringing standardization in the worldwide economy. Fine. Let us now come to key accounting concepts that forms the fundamentals of accounting. So that before we go ahead and prepare our profit and loss account, balance sheet, cash flow statement, etc., we know that what are the main underlying concepts that based on which we'll be treating our financial transactions. Right? First one is the cost concept. It is also known as the historical cost concept, where we say that non-current assets are recorded in the balance sheet at their cost, reduced by depreciation only. So we will record every non-current asset or fixed asset, that is those assets which are going to be there for a long period of time in the business. We will record the value of these assets in our balance sheet only at the cost at which they have been acquired and reduce them year on year by depreciation. That is it. We will not record it at the value they are at today in the market. Right? The reason for this kind of a concept to be held is that it makes life easy and a straightforward method. But this does not actually show you the true picture of the company, because the assets are not being reflected at the true market value. Instead, they are being reflected at a historical value. Right? So it is not giving you a true picture of the financial position of the firm. Allowing for recording assets at their fair value is volatile, but it gives a better view of the company's financial position. So the contrary view is that instead of recording the assets, that is the fixed assets at cost, we can record it at the fair value or the market value that is prevailing today. But then if you do that, it will make the balance sheet or finance statements very, very volatile. At the same time, there is no single method of evaluating the market value of a particular object or a particular asset every single time. So then it becomes a little difficult to believe as to whether the recording or the financial records that are being maintained are being done in a just and a true manner or not. Lastly, looking at the key changes that are taking place across the world, we can definitely conclude that there is a gradual shift towards fair values, and that can be seen in all the industries. Let us look at an example. A piece of land is bought by a company for 2 crore rupees. If we go by the cost concept, it will be kept at that 2 crore level only in the balance sheet till it is sold off. And it converts into cash. Irrespective of the fact that whether the market value today is more or not, even though it has been years since we bought that land. So for example, we bought that land in 2000 and today we are sitting here in 2017. The price of the land then was 2 crore rupees. Till date, in my accounts, I will keep it at 2 crore rupees, irrespective of the fact that today that land might be costing, or the market value of the land might be 5 crore rupees or 10 crore rupees. We will not be showing that in our balance sheet. So what we are actually showing is an untrue picture of the financial position of my firm. My firm's assets should reflect that the land is worth 5 crore rupees. Instead, it is still reflecting it is worth 2 crore rupees. Money measurement concept. Money measurement concept states that matters that can be measured in monetary terms only should be included in the financial statement. So anything that cannot be judged in a monetary manner should not be included in the accounting of your business. This is also used just to simplify accounting and make it more objective rather than subjective. Value of a business, however, value of a firm, value of a company, however, is not just restricted by these aspects. It will also have to take into consideration important factors such as brand value, customer loyalty, customer base, employee skill level, research and development techniques, modeling techniques, etc. that the company has, which will give them some sort of more value addition in their existence rather than just having things which can be done in monetary terms. All right. So things which cannot be recorded in monetary terms, unfortunately, are not reflected in our accounts and remain unaccounted for. However, directly equating the value of whatever is value of the assets that are reflected in the balance sheet to the value of the company is not the best thing to do because of this concept. Suppose we want to find out about the value of a sports club. This cannot be assessed just based on the earnings through endorsements, winnings, tickets, or assets like the stadium or different kind of machineries that they might be having. A major factor that anyone would take into consideration if they are willing to purchase a particular sports club would be the skill level of the players, skill level of the coaching staff, history in terms of the culture of the sporting club, etc. that they are carrying around. And then looking at all these monetary as well as non-monetary aspects, they would be able to value the sports club in a much better manner. Business entity concept. Business entity concept states that a business is a separate entity from its owners. Therefore, business affairs should be kept separate from the owners. This is quite obvious, but still stated explicitly as a standard, as mentioned earlier under the IFRS negatives. It helps us measure the performance of the business easily. All right, because you're separating the owners from the business, you can objectively look at how the business has performed and not get confused between the business's performance and the owner's performance. Right? It ensures that the businesses can be compared irrespective of the owners. So it does not mean that if the owner is good, the business has to be good and vice versa. Right? You can completely keep it aside, the business from the owners, and look at each of them objectively. So for example, if company A's owner is Mr. X and you have entered into a contract with company A, it does not mean that you have entered into a contract with Mr. X. You have entered in contract with company A. So if company A defaults on the contract, you can sue company A. You cannot sue company Mr. X for that. Another example for it is, if a partner has given a loan to the partnership firm, this will be shown as a credit or a loan in the partnership's account and to project a true and fair view for the firm's position. It will not be considered as the same that its partner's money is equal to the partnership's money. It's not like that. So in the partnership's account, it will be shown as a loan forwarded by the partner to the partnership firm to show or project a true and fair view of the firm's financial position. Realization concept. Realization concept tells you that income is recognized when it is earned. It is not recognized or it is not recorded when the cash settlement takes place. So it will be realized as and when the moment the deal is struck and the revenue is recognized. Fine. This concept may lead to a mismatch in revenue and cash flow because credit sales will also be accounted for. So the realization concept says that even if you have made sales on credit and the money is going to come to you, say 3 months down the line, you will record it as a sale the moment you have made the sale and not when you receive cash. So this is where the cash flow and profit mismatch occurs due to profit and loss account, where the profit and loss account will take into consideration all the sales, whether they are credit sales or cash sales, to calculate the profit for that accounting period. However, the sales might not be equivalent to the amount of cash that is being generated because a large part of it might be on credit terms. This concept is used alongside the accruals concept, which we will see next. But before we go to the accruals concept, let us look at an example of realization concept. A shopkeeper sells goods worth 50,000 rupees on 30th March 2017 but receives the payment for it on 5th April 2017. Since the fiscal year ends on 31st March 2017, the sales of INR 50,000 should be recorded for that year only and not year ending March 2018, even though the payment was received after 31st March 2017. So you will record it in financial year ending 31st March 2017, showing that a sale of 50,000 was made, irrespective of the fact that the cash was settled post that date. Like realization concept is for revenue, there's something called accruals concept, which tells us that expenses are recognized the moment they are earned and not when they are paid, right? So realization is for revenue, accruals is for cost or expenses. This accruals concept alongside the realization concept helps in recording for incomes and expenses for the respective periods of when they are earned and incurred, and not on the basis of when the cash is settled, right? So the realization concept and accruals concept make sure, these two together make sure that whilst you're preparing a profit and loss statement for a particular period, you are taking those incomes for that period which leads to revenue, as well as those costs which are related to that period only, not when the cash is paid or cash is received from the cost perspective or the revenue perspective. All right. Whenever the cost is incurred, it is recorded for that period. Whenever the income is earned, it is recorded for that period. Right? Carrying forward that example, a shopkeeper, instead of now selling, purchases goods worth 50,000 on 30th March 2017, but pays the money for it on 5th April 2017. Like we did in the previous example, we included the revenue of 50,000 rupees for the financial year ending March 2017. Similarly, over here, we will include a purchase of rupees 50,000 in March 2017 and not March 2018, irrespective of the fact that the payment was made in fiscal year 2018. Right? Matching concept, realization and cost concepts together help in applying this concept called the matching concept. It states that incomes and expenses of the same period should be matched and dealt with together in the same income statement. Here, so if the income has been earned in a particular period of time and cost has been incurred in that period of time, then they should be dealt with together in the same accounting statement and not separate ones, depending on when the cash was settled. All right. Expenditure incurred to generate income in a period should be accounted for in that period only. So if I sold goods in year ending 31st March 2017, then the goods that I have sold, I must have incurred a cost in purchasing those goods. So the purchase for those goods, the cost of purchase for those goods should also be put in that income statement only where the sales are being recorded and not when the cash is being settled, right? The example here is that if a policy was sold and the premium was collected for it, for the sale, a commission was given to the agent. So the income and sale happened during the same period. Now, irrespective when the payment of commission was made and the premium was collected, both these items should be presented in the same income statement. So the premium of the policy as well as the commission that you had to pay to the agent should be a part of the same income statement and not when the premium was actually paid to you and commission was paid to the agent. Dual aspect concept. This concept tells us that any transaction will affect at least two items in your accounting statements. This is also the backbone or the fundamental reason why we have double entry bookkeeping. For example, cash sale of goods will increase cash and reduce stock for the firm. In case the sale is on credit, then for a decrease in stock, an equal amount of increase will be there for debtors, right? So you can see at least two items or two things are being affected by every transaction. Materiality concept. Materiality concept tells us to present items that are material to the stakeholders. So this becomes a little subjective for the management that decides that what are the things one should report on and what are the things one should not report on. So it is their discretion that comes here, that what they consider to be material for stakeholders and what they consider to be immaterial for stakeholders. Too much detail should be avoided and clubbed under respective heads. For example, if you're running a particular company, you're using pen, pencil, and different other stationery items on a regular basis. So rather than giving each and every item individually in your accounts, you can club them together and put it as stationery. Fine. This concept brings a lot of subjectivity into accounting and thus gives the management some sort of flexibility as to how they want to report their statements. An example of this can be a fine due to the breach of guidelines by an insurance firm should be disclosed in the accounts irrespective of the amount, since it is a material thing for the stakeholders to know about the penalty levied on the firm. Here the firm cannot say that, or the management cannot say that, the amount was not so significant, that's why we did not report it in our accounts. It's irrespective of the amount, even if it is say 1 lakh rupees, 5 lakh rupees, 10 lakh rupees, it does not matter. The size of the penalty does not matter. The fact that there was a penalty that was imposed upon the firm, there was a fine that was imposed upon the firm due to breach of guidelines, it should be something that should be reported in the notes to accounts so that the stakeholders can take note of it. Prudence concept. Prudence concept tells us that one should be cautious whilst we are reporting about our incomes as well as expenses. We should avoid being too optimistic. So to avoid being too optimistic, one should quote the lowest reasonable figure for any assets or income that we want to project or we want to present in our statement. The lowest reasonable figure, that is that figure which we are 100% certain about, that only we should report in our assets. Highest reasonable future income or highest reasonable figure for liabilities must be reported on the other hand. So if you're talking about the assets, only those figures that you're 100% sure about, so the lowest possible figures. On the other hand, highest possible figure for liability should be reported, where you can try and make sure that the right amount is being reported by the right through the right channel. Fine. So highest reasonable figure for liabilities, lowest reasonable figure for assets. One should though not be overdoing this thing and misrepresenting facts. So if you're 100% sure, then also if you tell us that no, we are still a little bit uncertain about the income and we will try and show a lesser optimistic picture, that is again not showing the true and fair view. So don't give your results in an over optimistic or an under optimistic manner. Keep it genuine, keep it true by stating the lowest reasonable figure. Remember, reasonable figure for assets and the highest reasonable figure for liabilities. Prudence should be used only when there is uncertainty. If you're 100% certain about your income or about the liabilities, then stick to those figures. Don't change them in order to become over prudent. Fine. One should make provisions for any sort of liabilities that might arise according to the kind of business we are in. So for example, if the firm has a debtor that owes 1 lakh rupees to it, and upon detailed analysis, the management feels that this debt might not be fully recovered as the debtor is going to go bankrupt. So now instead of showing rupees 1 lakh in the assets, the firm should reduce this amount to a realistic figure that they believe can be recovered from the debtor. So here there is an uncertainty associated with the debtor's bankruptcy. At the same time, there's an uncertainty about the amount that the debtor will be able to pay us or we will be able to recover from the debtor. In such a situation, we should quote the lowest reasonable figure. Since it's an asset for us, we should quote the lowest reasonable figure if we are following the concept of prudence. The going concern concept tells us that we should assume that the business will continue indefinitely. This justifies the use of cost concept because it assumes that the asset will not be sold ever, since the business is going to continue indefinitely. So the assets are not going to be sold in the near future. So why should we take up the hassle of recording them at fair value or market value when it is not being sold? It assumes that the businesses will not shut down in the foreseeable future. That is what going concern concept tells us. That is why we'll keep believing whenever we are investing that the company is going to go indefinitely into the future. The alternate method or the alternate concept to going concern concept is that we prepare accounts assuming that the company is going to wind up or shut down immediately. This is known as preparing accounts on the winding up basis concept. Right? Here, it obviously will pay rich dividends if we could record the assets at the current market value or the realizable value if they are being sold in the near future, and to see whether they can be enough to pay off the debts of the creditors or not. Let us look at an example. Company A manufactures a medicine using special machinery, but the new policy has banned this drug. Now this firm is no longer a going concern. Company B is under huge financial stress. However, they have been given a loan by a creditor in adverse times. Despite the adversities, the company shall be treated as a going concern. So you can see that company A was manufacturing a medicine, right, using a special machinery. But now suddenly there has been a policy change by the government which has banned the drug. Now when you prepare the accounts of this company, you will prepare it on the winding up basis, or you'll assume that it is going to be no longer a going concern, despite the fact it was going pretty well before the ban happened. Company B, on the other hand, is under a financial distress. However, even during these adverse times, it has found out a creditor who is ready to lend it money to come out of this financial dilemma. Despite all these problems that companies B is facing, we'll assume that it is a going concern while we are preparing its accounts, right? Consistency concept states that company statements should be comparable across years. Thus, policy should not be changed here and there again and again by companies while recording certain values in their statements. Policy should not be changed again and again, and if they have been, then the management should report it in the statements. As mentioned earlier, that in the notes to accounts, the management should tell us that what is the policy it has adopted to calculate any figure in the statements, and they should highlight if there has been a policy change in recording certain figures. A reason for the change of policy must also be mentioned. Alongside the reason, it should also tell us the effect that the change in policy would make. So for example, if the firm used to follow a straight line method to charge depreciation on its fixed assets till last year, however this year they have switched to reducing balance method, then they should report this in their financial statements. It should also tell us that what the reducing balance method will have an effect, how reducing balance method will have an effect on the balance sheet or the profit and loss account vis-a-vis what the straight line method would have had. So the change that would be there as a result of the change in policy should be highlighted by the company in its notes to accounts, right? Finally, any concept or any convention that the companies follow has to make sure that the information that is being presented through the financial statements of the firm is reliable and relevant. Both reliable and relevant. It should provide us a faithful view of the company's financial position, performance, and cash flow. The accounts should reflect the economic importance of the transactions. It should be prudent. The information that you're providing should be prudent. It should not be too over-optimistic or under-optimistic about the performance of the firm. Material things should be reported on and not be skipped upon or not be brushed under the carpet just because it might show a negative picture about the company's well-being. And lastly, it should be free from bias. It should be absolutely free from bias whilst the management prepares the accounts for the stakeholders. For example, a financial lease used to be previously showed just as an expense in the income statement. If you guys remember, we had talked about financial lease in an earlier video of ours, where we talked about operating and financial lease. A financial lease was where if you take a product or take an asset on rent, where the rent term is almost equal to the shelf life of the asset. Alright. So previously it used to be shown just as an expense in the income statement. However, economically, if you see, the whole asset is being used by the lessor because your term of the lease period is the term of the lease, that is the lease period, is equal to the shelf life, is almost equal to the shelf life of the asset. So in effect, if you see, you are the only user of the asset. This is why now the process of reporting any financial lease has changed. What it is now reported is like, it is shown as an asset as well as a liability. The lease arrangement is as an asset where the payments are to be made as the liability, and the payments will be a component of both the capital and interest, right? So you increase your asset side as well as your liability side by the amount of the asset or the total figure that you have to pay as rent to the original owner of the asset, right? So this is it for this class, where we have understood that why one needs accounting, what is accounting, and what are the basic concepts that one needs to follow while preparing financial statements. One key thing that one should keep in mind always is to make sure that we are giving the stakeholders a true and fair view about our company's financial status. At the same time, we should report about all the material facts and figures in a prudent manner without any bias, right? Thank you very much.